Well, good morning and welcome to this Airmic Live session on insurance market conditions. I'm Hoe-Yeong Loke, Research Manager at Airmic, and I'll be your moderator. And I'm delighted to be joined by a brilliant panel today, whom I will introduce in a while. Airmic is conducting a series of pulse surveys amongst its members, focused on insurance market conditions. The latest survey conducted last month, January, focused on claims and renewals. And we will be discussing the findings of this survey in today's session. First, on the format for today, my colleague at Airmic, Alex Frost, will take us through the survey results. We will then discuss the findings by four main themes: claims, renewals, captives, and then Brexit. I will invite our panelists then to share their thoughts and insights on each of them. And finally, we will have some time at the end for questions from the audience. So if you would like to ask our panelists a question, please send them in through the chat function. So let me now introduce our panelists one by one. Stephanie Ogden is on the UK and Ireland board of HDI Global SE, leading distribution. Under Stephanie's remit is all broker and client engagement, along with the marketing and branding for the business. Stephanie joined the HDI business from Lloyd's of London in September 2019. We also have Scott Feltham, who is the Group Insurance Manager at Compass Group, the largest food service provider in the world, operating in 45 countries. Scott has responsibility for the insurance arrangements and strategy for the whole of Compass Group. We have James Pryke, who is Head of Placement, Retail, Property, Casualty at Lockton, where he's a partner. We have Richard Sheridan, Director and Head of Corporate at Sedgwick. Richard has worked in the corporate risk sector for an insurer, broker, and now Sedgwick, where he heads up their corporate division. In addition, Richard takes a leading role in Sedgwick's digital development and the implementation of behavioral science and data analytics. And last but not least, my colleague at Airmic, Alex Frost, who is Market Development Manager, who works closely with Airmic's members and partners. He has a background in political risk and joined Airmic after 10 years in global insurance at Exco Insurance Information Services in London. So without further ado, Alex, the floor is yours.
Thank you very much for that, Hoe-Yeong, and good morning, everybody. I realize this is supposed to be an overview of our recent Pulse survey on overall market conditions. But before we do that, one of the elephants in the room obviously dominated the first question of this survey, and this is, of course, that the UK, following Brexit, has now formally left the European Union and the transition period and has a deal of sorts with the European Union. And we did want to know from our members, as far as the insurance sector is concerned, what their concerns were. And I think the key word that we are hearing here from our members is uncertainty. This is uncertainty around logistics, uncertainty around regulation, uncertainty around costs. Obviously, as you can see from the results here, the biggest concern of the membership is that there will be hidden costs, such as issuing additional local policies or fronting costs. But there are also concerns about regulation. Obviously, what is the future of the EU Solvency II framework and the capital requirements, and will there be a sort of UK-based equivalent requirement? So food for thought, as always, on Brexit, and we'll continue to monitor this throughout the year and as more details of the deal become apparent. So if we move on to the next slide, I think what's important to keep in mind in this survey is that in many ways, what we're looking at here is a continuation of the market conditions that Airmic has been describing for the last year or more as the harsh market. And obviously, why do we call it that? As we all know, a hard market is defined by higher prices and a lack of capacity. The last hard market really was back in the early 2000s, and so while doubtless a new generation of underwriters and actuaries and brokers have grown up in soft conditions, I think there are many who can still remember and who worked in a hard market. But the harsh market is how we define almost a perfect storm of conditions that creates sort of unique challenges. And these are, of course, higher prices and larger deductibles, a lack of capacity, but especially and significantly, what some have been saying is a breakdown in meaningful communication, which is often spoken about as a lack of consultation, a late provision of terms. And I and Scott were on a panel at Airmic Fest, our digital conference earlier in the year, where we discussed some of these. And part of the purpose of these surveys is to see how perceptions of the market are changing in response to Airmic's discussion of these issues. The Pulse survey is designed to take a snapshot of market conditions, and so there are similar questions in all of them that allows us to conduct comparisons. Higher rates have been with us for some time in the hard market. Prices have been increasing really since, well, arguably since 2019. But reports of a rise in lack of capacity is apparent from what we are seeing here, that there's been a 16% rise in a year of our members saying they're seeing lack of capacity. Also, a 36% rise in exclusions. And despite it being a sort of a message that we talked about a lot at Airmic Fest, when it became apparent to us in Q1 of last year, our members are still suggesting that there is a rise, an almost 30% rise in the reporting of poor or late communication. But I think we'll probably see that goes both ways. If we move on, one of the bright spots that we are monitoring is the claims experience, and that was true in Q3 of 2020, that over half of respondents were saying that the claims experience was very satisfactory. Small dip there, but vast, at least half of respondents, so the vast majority are say it's either somewhat satisfactory or very satisfactory, with half saying somewhat. So 96% of respondents are pleased with their claims experience. On the next slide, we look at what our members are saying about whether they are pleased with their insurer's performance. And I think there's good news here, that only 16% of respondents in 2020 and 18, so statistically almost statistically invariable, suggesting that they were not satisfied. I'm sorry, I read that backwards. 18 in 2020 and 16 in 2021, so a small improvement in not satisfied. And again, over 80% of respondents saying that they are very or somewhat satisfied. And we've seen a slight uptick in the very satisfied. In lines of business, I think there is a continuing trend. I beg your pardon. Likewise with brokers, we're seeing 64% say they are somewhat pleased, and 34% very satisfied with their broker's performance. So a strong performance from the broking sector there. On the next slide, we look at lines of business. And there's a continuing trend here that we spoke about last year and continues to be a major area of focus for us. And this is the rise in rates around directors and officers coverage. Over 30% of respondents say they have seen rises of 100%, and over 10% of respondents are suggesting they have seen rises of over 400% in the first quarter of 2021. Does this reflect the reality of the risk, as there are concerns over liability as the overall economy stutters and company performances come into question? Is it, as some darker voices suggest, is it price gouging, or is it higher defense costs that are driving this? And I think that's a very interesting question if our panel gets to discuss it. There are still significant rises in PI and employment liability, although not as high as D&O, and still quite significant rises, although lower, in the other financial lines, especially in crime. Moving on to the topic of captives, we can see on the next slide that we ask our members, does your organization use one or more captives? And despite concerns that industry use of captive use would rise in the harsh market, we're seeing that the numbers are fairly constant, that they haven't fluctuated very much. Although, interestingly, our panel at Airmic Fest earlier in the year pointed out that, and I think it was you, Scott, pointed out that deciding that market conditions require you to have a captive and deciding that you're going to use one and then making that a reality and then shifting a portion of your premium spend there actually is quite a long process. So we shouldn't expect to see a significant rise in only 2 quarters. There is a slight uptick, however, in those considering it. If we move to the next slide, if you do not already have one, are you considering the formation of a captive in response to the hard market? 23.4% said yes, although again, that's a very small increase and potentially interesting and surprising given the market conditions that are prevailing. On the next slide, we ask, how will your approach to the renewals process change as a result of the hardening market environment? Also, we've seen that captives, increase interest in captives has not been that pronounced. There are plans, however, to explore alternative risk transfer, and those have remained quite high. Over 60% of respondents are still considering that, and over 80% are planning to increase self-insurance retentions, while 53% are looking to reduce the scope of cover. So I think change is happening, whether that is change in attitudes or whether that is actual change that is now filtering through into policy. We will have to see. But happily, the willingness, as you can see, is there to begin the renewal process earlier and to provide more data and information to your insurance partners. And I think that is our industry suggesting that they really want to go the extra mile in terms of communication and sort of breaking down those barriers. Moving on to the focus of the specific focus of this one of our Pulse surveys around claims. As I say, it's a bit of a bright spot. 2 years running, it's been a bright spot. The majority say that there has been no increase in challenges to claims in the last 12 months. Just under 30% yes, a slight increase, but I think that's probably very positive from the perspective of the members. On the next slide, 76% of respondents are saying that claims, when they were paid out by insurers, the claim service met their expectations. Again, I think very positive. But on slide 12, we can see that 52% say that claims were paid out quickly, promptly, which I think helps them explain why service expectations were met. But interesting, I find on this slide, 19%, so just under 20, say that the payout was much slower than usual, even after accounting for the COVID-19 situation, which I would say is a fairly significant number of respondents. I'm interested to hear why we think that this is slower even after accounting for COVID. So hopefully we'll come back to that. On slide 13, where claims were paid out by your insurer, did the claim payment match your expectation? Yes, it matched expectation, 85.7%, which is very, very good. And finally, when claims were rejected, number 14, what was the predominant reason for that rejection? And here we see that it is usually late notification and an inability to provide the information requested by the insurer. So maybe this contributes to the difficulty of poor communication. On slide 15, there is little change we see in plans to litigate claims compared to before. Over 80% are suggesting that they plan to maintain their current strategy in that respect. And finally, on slide 16, we see that when you ask how will your approach to expert claim support change in future, there are sizable portions of respondents who are likely to instruct their broker to support and likely to instruct their lawyers to support. But overall, 43% of respondents say no change. So it's a fairly nice balance, I think. So that is the overview of the presentation. I think for me, the issues that stand out are that many of the hard market conditions remain, and there are still strategies being considered as to how our membership will respond to that. I think personally that the response to that will have to come through greater collaboration between all parts of the market, which is a theme that we have been talking about for some time. But overall, in the focus of this section on the claims environment, I think the membership looks fairly satisfied. So with that, I will hand back to Hoe-Yeong and to the rest of the panel.
Thank you very much, Alex, for taking us through that. 20 slides in 10 minutes. Bravo to you, Alex. But obviously, we will have a chance. We will have a chance to go back to some of the issues that we have raised through that presentation in the course of the next 45 minutes. So let's start with claims, the main focus of this survey. And I wonder if we could start with Scott. So what we're hearing is that from our members is that they're seeing increasing challenges to their claims, but where claims are being paid out, they have been pretty satisfied with the whole experience. So Scott, could you share with us how has your claims experience been in the past 12 months? Does it match the survey results perhaps?
Thanks, Hoe-Yeong. Hopefully you can hear me. I've got a bit of background noise there, but thank you for that. And thanks, Alex, for going through those slides. Certainly makes for interesting reading. It's a good question, Hoe-Yeong. What's our claims experience been like in the last 12 months? On paper, it looks largely good, largely positive, but that's for entirely negative reasons. I mean, if you allow me to sort of frame that answer with a bit of detail. For those of you who don't know, Compass Group, so the world's largest catering firm, operating in a variety of sectors, we were hit massively by COVID-19 in terms of our ability to operate. If you look here, I won't go into too much detail here, but if you look at sort of 70% of the group's revenues in ordinary times, we generate in the sports and leisure, business and industry, education sector. So it doesn't take a rocket scientist to work out that, look, we were going to get hit hard. I think back in April of last year, we had roughly 55% of the business out of virtual standstill, inoperable. That's across 50 countries, approximately 55,000 locations in good times. So we were hit very, very hard. One of the biggest falls in the FTSE 100. So back to the question. So with all of that in mind, back to the question. On paper, our claims experience looks very positive over the last 12 months. We've simply not suffered the incidents that would ordinarily give rise to claims. So on paper, you're looking at it, I think actually looks pretty good. But again, all of that is down to a complete and utter negative. We've not been operating in certain parts of the world in those specific sectors. I'd be more satisfied if, of course, we were still fully operational and we simply weren't suffering the losses. We were doing our utmost to manage risk in each of the sectors, and we were simply not suffering the losses. So I wouldn't say our claims experience has been good. It looks good on paper, but because of a negative. Of course, I'd much rather that we were fully operational. We're not at this point. There are some green shoots. Things are starting to improve. At this point, we're not seeing the same sort of volume and frequencies of claim that we would ordinarily expect. I think that will come in time as the recovery sort of rolls out further across the world. I think for me, my main focus at this point in time is what's going to come out of COVID-19. Are we going to see a rise in different types of claim? For example, are we going to see a rise in employers' liability claims relating to COVID-19? If you bear in mind that most of the clerical workforce within any large corporate is working from home, sat in their sort of spare bedroom stroke office like me, sat in a chair that I've bought at a desk that I've bought myself. Compass Group, I speak very positively of Compass Group. Compass Group have been very good in terms of doing their risk management around workspace and stuff like that. But, are we going to see an increase in EL claims across the board in relation to people working from home? I have a major concern more generally regarding mental health. Are we going to see an increase in claims relating to mental health, people's mental health. So that's my main focus at this point in time, as we've studied the ship within Compass. Incident frequencies have been down tremendously, purely on the basis we've been inoperable in parts of the business. My main focus has been and continues to be, what are we going to see out of COVID-19? Is there anything around the corner that we're likely to see by way of an increase in claims? So that's my take on matters. And I think, if you look at your survey results, which talk about, that the participants being largely satisfactory with their claims experience, it might be sort of representative of the answer I've given, where it looks good on paper, but that's partly because there's been a reduction in exposures. So yeah, they're my views on matters. So yeah.
Thanks, Scott. Turning now to Richard, and then I'll turn later to Stephanie and then James. Richard, so what do you think is the single most important part of the claims experience which you think could be improved?
Yeah, good question. The results were encouraging in that people seemed largely satisfied with the experience that they were getting from their claims providers. I think for each client, that's obviously going to be different. So as a claims provider, we should talk to each client and say, firstly, which part of your experience could you improve the most? From a personal perspective, and an area that we're doing a lot of work on is just the actual incident itself. So, when the loss happens, because the person that is the first responder or that gets notified about it is very unlikely to be an insurance person or a risk person. It's going to be an operational manager. So how do we support them at that time? Because first and foremost, it's a very stressful thing. Someone could have been injured, there could be a fire, a flood, whatever it is. Hopefully that's a relatively unusual event for that individual to deal with. So that in itself is stressful. And the last thing that we want to be doing is adding on more stress, through adding in bureaucracy and process and all the rest of it. So we're looking at how do we support that individual in the moment of the loss happening. So what they need is easy access to guidance. So before they even pick up the phone, how do they know what to do to make the situation safe, to mitigate the damage, to support the people around them? So how do we get that information in front of them? How do we get the ability to speak to someone quickly and easily? So often an issue is contact lists can be very out of date. We did a survey actually of risk managers in the public sector a while back, and the overwhelming feedback was that business continuity plans were really quite hard to read and work out very quickly exactly what you needed to do right there and then. So how do we get the contacts right in front of people so they know who to pick up the phone to if they need to? And then finally, how do we enable them to tell someone to share that information? So that's an area that we think that we can spend a lot of time supporting clients with. And there's massive benefits to that, because obviously, it helps that person in the moment. And if anything then demonstrates the value of risk management and insurance, it's that. That's the moment at which they suddenly realize why this stuff is important. So it's supporting the person in the moment, but also it's about getting the claim off or that situation off to a good start, making sure that the information is captured to, whether that's to improve defensibility or to help mitigate the loss. And it's about also giving them the confidence and trust that this is going to go well. So that, I think there's a lot we can do right at the outset of an incident to make that experience for the organisation a better one. And we've been looking at how we can use technology to do that. And the key really is to enable that information to be available very easily from a mobile device prior to a loss happening. I'm working with organisations, such as the members of Airmic. You push out applications and technology and information to people. So there's not a sales pitch, but we've developed a way of doing that so that essentially that operational person has a panic button that they can press, and then they can access the information they need to manage that situation in the moment. So that's an area that we think is an area for real improvement. But it's good to see that overall the satisfaction levels seem to be good, but I think we can always do better, whatever it is. So we should never be complacent.
Thank you, Richard. I think technology is going to be a big theme here indeed. So Stephanie, if I may turn to you now. How have insurers been dealing with claims throughout 2020, right? Especially given the COVID-19 situation and the amount of claims being filed?
Yeah, so morning everyone. from our perspective at HDI, our priority has been from the start that we need to make sure that we're paying out claims as quickly as possible. Obviously, like everybody on this webinar, we had the challenge of working from home, literally within 24 hours notice. But actually, we have found that we have been able to deliver that service and make sure that we are paying out the claims as quickly as possible. So therefore, the data coming out today in the survey that the Airmic members feel that 19% are saying that it's slower, even with COVID, I would say is slightly more of a disappointing result. Some of the things that we're doing to, I suppose, continue that claim service that we aim to deliver is around the communication. We are making sure that we're communicating with our clients as early as possible and throughout the entire cycle. So not just when claims occur, but actually during the whole policy period. And we actually have put a lot of priority on our communication with brokers. This is incredibly important. It's not just about the clients in this perspective. We also need to make sure that the brokers are well informed as well, so that we're making sure that that tripartite relationship, there's no gaps in information, and almost speaking to Richard's point, making sure that everybody is well informed during what can be a stressful process when you're working from home, and you want to be on the ground acting upon the claims. We were pleased that the loss adjusters, you know, they are considered key workers. So for us, getting out to the claim wasn't necessarily impacted that much. We still made sure that we could do that. The other point, though, to make, as you've said, is around technology. So we have maximised our investment, or started to invest a lot more in terms of apps that we can give our clients access to, that can give us real-time updates and visuals as well. We have also, we are starting to trial sending drones out. So sending a drone to the client location to be able to film themselves any damage and property-led damage. So I suppose that's almost a positive that's come out of the last year, because maybe we wouldn't have put that investment so quickly in. We probably weren't there yet, but COVID has driven that activity and made sure that we prioritise it. So yeah, I mean, some of the results I think in the survey are positive, but 19% saying it's been really slow is not a good result from our perspective.
Just a quick word, Hoe-Yeong, if you don't mind. Sorry to jump in there. I mean, notwithstanding the fact that we've suffered very few claims, or less so than we would ordinarily expect. Yeah, the claims that we have lodged, that have been dealt with. I mean, I'm not trying to blow smoke here or anything, but I've seen no impact on, or no negative impact on service levels, you know, from insurers, TPAs. I think that's been dealt with pretty well. You know, I think the comms piece has been pretty good in terms of, you know, how insurers, how their claims departments, how, you know, TPAs, how they're operating, you know, with their staff working, so yeah, broadly speaking, from home. I think that's been pretty good. I personally have seen no impact in terms of, yeah, the speed at which claims are paid, our expectations in terms of what we thought we'd get paid. So I think that's been largely good. So I think the results, as Stephanie says, are interesting, actually, make for interesting reading.
Yep. Thanks, Scott, and thanks, Stephanie. Turning now to James, and again in the context of the pandemic, right? How are brokers working to reassure clients, help them get the cover they need, and advocate for them when they have a valid claim? Any thoughts to share, James?
Well, I think the first thing to really address is to come along and be able to understand the client. If they look at Scott and Compass and turning around and saying he's no longer been able to operate his business as he once did, that's obviously a very, very different risk and a very transition to some of our healthcare clients that are either trying to care for patients or trying to get drugs to various people or administering things in different ways. So both for the businesses as going concerns and also the claims process is absolutely essential to understand what's important to the client, what's needed by the client, and what resources they've necessarily got available to them already. A broker doesn't need to give the entire solution. In fact, a broker can't give the entire solution. So by working with Steph at HDI, with other insurers, with TPAs, there is very good processes and protocols in place with the majority of clients. So it's really listening, understanding, and getting the right people involved when that process doesn't necessarily work. And this is the situation we're going through now, because that change is directing something that means that before, when the IT system or anything else in the protocol worked, now it's not working in quite the same way. So we need to be flexible and navigate and get the correct individuals and the correct thing and the correct people involved, and try and look at coverage, and where the coverage is grey, looking to be able to define and get together with the client and the insurer as well. Everybody wants to do the right and the honourable thing here. It's not one against another, and ultimately, by trying to bring everybody else on that journey, we think we can install the confidence, and second of all, get the best and the right outcome for the client, both for the claims side but also the renewal, because the renewals happen every 12 months, and suddenly when we're looking at, goodness, if I claim for this, is that the right thing to do for my renewal process, and where it goes on, and it all links in, it's all intrinsically linked together.
Thanks very much, James. On the theme of working together, which James is speaking to, I should have reminded, obviously, everyone in the audience here that we are releasing the survey report at the end of this session. So look out for the link, which I will send to everyone here at the end of this session. So that is on claims. We now turn to the issue of renewals, next big theme in our survey this year, this quarter rather. James, and then maybe I'll ask Stephanie this question too. Insurance buyers have been telling us for some time in our surveys about the need for stronger communication, that, as you have just spoken to, stronger communication from the insurance partners about dissatisfaction at sudden, unexplained changes to rates and terms, and how are brokers and insurers responding to that?
Thank you. So I think, first and foremost, I think it's a very understandable concern. I do think there's a significant amount of information that comes out into the market, and I think it's almost a data dump rather than being specific enough to each individual. Goodness knows how many advisor updates and broker updates and insurer updates that everybody's getting each day. And to be honest with you, it's almost a full-time job keeping on touch and reading all of those. The next side of it is actually trying to understand what's relevant to you. So just because the Bermuda market has got a new CUO, or there's some new capacity coming into the market, or there's some hardening going on in one particular part of the world, is that going to affect me at this coming renewal, or is it not going to affect me at this coming renewal? So I think the first thing is trying to distill and make that specific by having a direct relationship with the operational broker, not necessarily the most senior person in the organization and who you have the relationship with, but the person that's actually out there live and feeding that information back to you. The other side of things that we're seeing is, ultimately clients are going through a far tougher position in terms of their business. The last thing they want is on their CFO's desk an increase in budgets for premiums, and then not even being able to get close to being able to hitting those budgets. So suddenly insurance that was perhaps at the end of a board meeting has suddenly been presenting. I know I've been in front of more boards this year than I've ever been in front of before for that very reason. And the softer market really coming to the point where traditionally the message was, we've managed to beat budget again this year. Well done, high five. We're all looking good. So I think ultimately it's having that relationship with that person that's in the market, trying to understand what's going on, and appreciating that ultimately the market is changing in a rapid way, and where insurers were looking at sort of offering terms 90 days before. If I look in the Bermudan market and the US market, nobody will even open the submission until 30 days before. The same is happening in the financial lines market. So I know we want to start early. I know we want to engage with people early, but ultimately we are being dictated to slightly in a marketplace, and goodness forbid when you lose AXA 5 minutes before your D&O renewal, and people also don't realise what on earth happens when you just suddenly drop off and lose your incumbent. So if you've had a great program, that cliff can be significant. So looking at plan Bs, plan Cs, ultimately it's making it specific to you and your organisation, and having a good link and correspondence with your broker.
Stephanie, do you want to add anything to that?
Yeah, I mean, sitting from an insurer's perspective, we focus on UK domiciled risks, so haven't necessarily got the international markets that we're reliant on. I suppose with clients where we lead, we work on a no surprises basis, both internally but also externally. So we have, don't get me wrong, right at the start, probably 18 months, 2 years ago, that was more of a challenge. But we're now at a point where we're not just talking about this year's renewal, we're talking about the following year renewal, and being able to have that dialogue with both our clients and brokers to pre-warn what activity they might see in terms of a change from an HDI stance. Now, what I hasten to add, that's not just about saying reducing capacity, it's also at identifying those clients where we want to build stronger relationships with, and identify those clients where we want to have a stronger partnership. So it isn't just about reducing capacity, but it's about being, I suppose, more targeted in the approach that we're taking. But certainly we work from a perspective of no surprises. It's not fair for client nor broker. There clearly has been a lot more surprises. We see it with the new business opportunities that we're getting in, and we're getting days to turn it around. Where we like a lot longer than that, but it is the reality of what we're working with at the moment. So I do think the market is getting better at delivering a difficult message. It was clear 18 months ago, so many people were difficult with saying, actually, no, we can't do that. I think people feel more comfortable now with saying, this is going to be a challenge, and I'm going to give you as much time as possible to respond to that and deal with that challenge. So yeah, that's probably from the HDI perspective.
Scott, I wanted to pick up on the topic of boards and senior management that I think it was James who brought up first. Scott, how have boards and senior management of businesses been reacting to the hardening market in insurance, and how have you sought to engage with your board and your senior management on these issues in insurance?
Yeah, so that's an interesting question, actually, Hoe-Yeong. And I guess, I joined Compass Group back in April of 2019. So I guess, just prior to that, the market started to take a turn, started to harden. So I've had experience with both Compass Group PLC and my previous suitor in terms of managing the board's expectations around the hard market. I think in a few words, I think initially the reaction of the board or the boards was of surprise. I think particularly the speed and pace at which the hard market appeared to come about. I know there were plenty of warnings, but of course we'd gone through a prolonged, I guess, period of soft market conditions where, back to James's point, I'll be honest, you'd be doing my job, you set your budget, you come in year on year within budget, you get a pat on the back to the extent where actually, insurance is almost on the periphery. Why would you need a board slot? You're doing your job, pat on the back, off you go. Make sure you come in within budget again next year. So I think actually the subject of insurance is, I think, of greater focus than it's ever been in terms of the board and senior management. Certainly at Compass Group, one of the first things I did was make sure I sort of come in, manage expectation around the hardening market. That look, this isn't necessarily short term. We're not going to go through one renewal and potentially see an increase in premiums. This could be as it is now for the next sort of 24 months or so, if not longer. So I think you just need to keep up that sort of expectation management. I mean, I seek to get in front of the board at least once a year. I try and do it twice if I can. You might have sort of a 5-minute slot, so you've really got to condense the update within that. But certainly within that slot, I will give an update on the hard market. And it's not so much just an update on the hard market. There's plenty of literature around that. Frankly, a CFO, a CEO could sort of gain access to a broker's website or whatever, the insurance news, for example, and find detail in relation to the hard market and why it's come about. I think as an insurance manager, as a risk manager, I think it's important that you go into the board and sort of explain how you intend to sort of navigate the hard market. I think you need to demonstrate that you've got sort of robust plans in place, and you therefore give confidence to the board that you can sort of adequately navigate that hard market. It's not just a case of sort of moaning about it, groaning about it. Well, actually, we've got plans in place to navigate the market. We're ready for whatever it sort of throws at us, and we'll come out at the very end having achieved the best possible results. So, I'd encourage sort of peers of mine to get in there as often as you can, give a good, concise update. But I think what's of more importance, demonstrate that you've got a plan of action in place in terms of how you're going to navigate the market. So that's my take on that, to say.
Yeah. Scott, could I stick with you if you don't mind, because I want to move on to the next theme of our session today, which is on captives, so on business and captives, and how they are looking at more alternative risk transfer solutions as a result of the hardening market. Are you seeing more and more businesses exploring these alternatives in line with what our survey respondents are telling us? Scott?
I guess I am to some extent. And I think, as insurance managers, as risk managers, I think we have to, in the current market, look at other alternative ways of financing risk. It's especially as the cost of conventional insurance continues to rise. I think you'd be doing yourself a disservice as an insurance and risk manager if you weren't to look at those alternative risk transfer solutions. And I think set against the backdrop of a hardening market, a market that is continuing to harden in some areas, I think it's important that corporates sort of reassess, kind of recalibrate their appetite for risk. Again, set against the backdrop of the hard market. It's all very well and good for me. We've got an existing captive which is reasonably well established at Compass. But look, as soon as I came in, I looked at options in terms of how we might utilise the captive to a greater extent, sort of balanced against our appetite, our tolerance for risk. We're using the captive more inventively nowadays. For example, we now put sort of non-damage business interruption risk through the captive. Where, if I'm brutally honest, the market has little appetite to underwrite those sorts of risks. And it took some time to convince senior management, the board, that was sort of the right thing to do. Those sort of non-damage BI risks, for example, they're not going to go away. They need to sit somewhere, so we can sort of incubate them in a captive, or just keep them where they are, sort of on the P&L. So we are looking to be more inventive there in terms of how we look to sort of finance risk. What is slightly odd is because I think the results of your survey sort of indicate that sort of peers of mine aren't sort of actively looking to establish captives. I've spoken to a number of peers of mine now who are assessing the feasibility to establish a captive as a means through which to sort of finance certain risks. But I think back to an earlier point I think you might have made, Alex. The formation of a captive, of course, won't happen overnight. You need buy-in from internal stakeholders. You need to convince your board, for example, that it's the right thing to do and how it could be of benefit. Then if that gets approved, if you get through that approvals process, you then need to sort of spend time doing the feasibility, setting up the captive, selecting a captive management firm, etc. It doesn't happen overnight. I think certainly in 2020, the option of establishing a captive perhaps came about quite late in the day. For certain peers of mine, those who didn't have a captive, you can't do it overnight. I think, as a minimum, you would need at least 6 months in which to sort of establish a captive and probably get to grips with it. So I think putting that to one side, I think if you look at other alternative risk transfer solutions, certainly at Compass, I'm happy to look at and entertain sort of parametric type solutions. The perception is that they are quite costly, so there's got to be real value in those, and that's something we actively continue to explore. But I think what we'll see over the next 12 months or so, I think, if you were to do this survey again in 12 months time, maybe even in 6 months time, I think you will see a bit of an uptick in terms of some of the participants in the survey, peers of mine, who are actively doing the feasibility around captives, looking to establish and form a captive. So I think that's something sort of worth monitoring over the next 12 to 18 months. Yeah.
After this segment on captives, I'm going to turn quickly later to Brexit, which is the last and final theme, and I'll probably ask Alex to give some comments in that segment. But before that, Stephanie and then maybe James, any comment perhaps? Can captives play a role in getting back to businesses, in helping people get back to business during COVID-19? Any thoughts there?
Conscious of time, so I'll just stress what Scott said. Really, from an HDI perspective, we would, from a COVID specific perspective, I think it would take too long to put in place a captive now to deal with COVID-19. The amount of work that needs to go into setting up a captive shouldn't be underestimated, as Scott has said. So it's probably only to agree with everything that Scott said.
James, anything you wanted to add?
Yeah, I think there's Captives should certainly be looked at. They should be looked at in the round, not just necessarily for during the hard market to take things on. They're an additional option to transfer your risk. I mean, Scott mentions an interesting point of trying to put business and risk into taking it off the P&L into the captive that necessarily insurers don't want to transfer, or certainly not at a reasonable price. There's other things like sublimits that can be increased to look at it on that basis. I think the interesting thing on some of the largest clients that we look at the moment is the development of looking at alternative risk transfer, looking at ART, sitting behind captives and trying to sit behind on a cross-class basis. So utilising some of the property premium, the liability premium, and the D&O to be able to facilitate something that completely changes the structure and tries to move you out of certain market cycles. So I think it's a direction and a journey that turning around and saying, if you had a captive now, you'd be far better off than you otherwise would be. I think you would be slightly better, but I think it's really having the option and really on a long-term journey looking at where you can possibly get to is the most important thing.
Right, and before we turn to the Q&A session at the end of our session today, the B word, Brexit. And if I may turn to you, Alex, for some quick comments and observations perhaps. Now that the UK has to deal with the EU since December following Brexit, as far as insurance is concerned, what would you be most concerned about, Alex?
Well, I think, and I stress that I'm not an expert in regulation, compliance, and equivalency and solvency. I think and the question of passporting, which in many cases has been done to death in the market, sort of speculations and discussions about it. But what I will say, and I think it's been fairly well said already, is that the agreement that we have with the European Union for our sector, I think, is much more revealing in what it doesn't say, which is very little about financial services, as what it says about manufacturing and trade, which is the part that was really emphasized, which I find scary, frankly, because so much of our trade with the European Union is done in services. It's really the powerhouse of our relationship with them. And obviously, I think there are a lot of gray areas that will need to be negotiated through the coming years over those questions that were raised around equivalency, around data sharing, around skills equivalency and recognition that will have big ramifications for our industry that are maybe not as well, not as widely discussed maybe as some of the bigger issues around things like solvency and passporting. But just to finish off, to say a word about the overall relationship between the European Union and Britain in the past few months, which will have implications for our industry. What we've seen in the last couple of months, first, the UK government's introduction of the Internal Markets Bill was extremely damaging to the relationship and level of trust between the two. The Europeans blew their stack, diplomatically speaking, about that. And then in the last week or so, the attempt by the European Union to invoke a portion of the agreement related to vaccines entering Northern Ireland has similarly damaged trust on the British side. So I worry about the future for negotiation for this vital sector in the coming year, because I think that the basis for trust has been badly eroded.
Thanks, Alex, for that. Q&A session right now. So I think I'll start with a question from the audience, and we have quite a number of questions from the audience on claims experience. So maybe it's something that Richard might want to pick up on. And the question is, can the panel comment on the experience on subrogation efforts, particularly with large or complex claims in what is now a more challenging environment to conduct forensic studies, collate information, and so on? Is this having a detrimental impact on the claims experience of customers? So maybe Scott or Richard would like to make some comments.
In terms of, so I think I'm not a mate. So in terms of I think forensics was mentioned there and the ability to gather evidence. So as Stephanie mentioned at the outset, we are able to get out to site, where that's reasonable. We use protocols to make sure people are safe, that clients are safe, that that's all done in the right way. So where it's required, we can still get to site and we can still gather evidence that will be needed for subrogation, whether that's forensics or just general evidence gathering. And I think also interestingly, Stephanie mentioned, using remote apps and video, etc. And we've been using that as well. And I think that's all secure from a data point of view. So actually, we can work with clients to get them to, if we can't get to site immediately, clients can actually, through the apps that we use, gather the evidence on a video, and that's secure. It's fully, compliant from a data point of view, so we can secure that evidence. So from our side of things, the claims handling side, getting hold of the evidence hasn't been, touch wood, at this point in time, too unduly affected.
Thanks, Richard.
I can add to that very quickly, Hoe-Yeong, but just very quickly. I mean, as I mentioned earlier, I've seen no impact, sort of negative impact in terms of service levels on a claims front. I would include sort of some of the larger sort of complex losses. I think you've still got the expertise out there. So some of the senior claims personnel who might have been about a while longer than tooth. I mean, they're still about. Sort of readily available. I think to Richard's point around sort of getting access to site as and when needed to kind of extract information for claims defensibility purposes. I've seen no major sort of downturn in that at all. If I'm brutally honest with you, I think it's been kind of broadly unhindered.
We have a question here, or a few questions rather, on renewals, and I'll try to cluster them. So perhaps James or Stephanie may want to respond. So the questions we have is it realistic for buyers to want to start renewals discussion earlier, or these exchanges of information earlier? Another audience member says that yes, insured can start their renewals process early, but underwriters have a tendency to limit their quotes to 30 days before renewal date. So question is there going to be a change with these caveats put out by insurers?
I think, yeah. I think it's an interesting point. I think the answer is, first and foremost, you need to start earlier. You need to start earlier to do the various bits that you are able to start earlier. So if you have an easier liability renewal and you can get that wrapped up to be able to concentrate on property or financial lines or EPL or whatever it happens to be, that is essential. So it allows you to start earlier to focus on the things that are going to be a real issue. It is still a market, and trying to push the market to be able to do things that they're not ready and not comfortable to do, i.e. picking up a submission 30 days before inception, is a continual battle. But I think as and where the market gets on top of where it is now, it will become more efficient, and ultimately people will get back to the position when they're doing 90, 60 days prior to inception.
From an insurance perspective, yeah, we would encourage as early as possible, to be honest with you. Even if things can't be signed really early, the communication, the data sharing, progress over the past year, survey reports, it all enables us to start working as quickly as possible to make sure that we can give as much certainty and clarification on terms. So from our perspective, no, we don't put hard deadlines like this won't stand, or the 30 days caveat. From our perspective, it's as early as possible.
Thank you. We have a question about the long-term relationships between insurance buyers and insurers and brokers. And the question is, would you agree that clients who did not shop around in the soft market are now being forced to change their insurance providers, as the insurers do not take the same long-term approach and, quote unquote, fully exploit the hard market situation? Scott, maybe as an insurance buyer, any comments on that?
Controversial question.
Yeah, no, I think, again, it goes back to one of the points I made earlier around sort of kind of reassessing sort of your strategy as a buyer. I think I've mentioned earlier on sort of reassessing your sort of risk appetite, that kind of thing. I think in a hard market, you do need to have sort of the wherewithal to sort of shop around, so to speak. To look at what else is out there. I mean, if we were talking about the housing market hardening, ordinarily you'd do that, wouldn't you? So I think you have to take the same approach to the insurance market. I mean, one thing which I would sort of tie back into the last question and answer given around the sort of renewal process. I'm not sure we should even start and finish it, if I'm brutally honest with you. With your existing carriers, it should be a continuous kind of cyclical process whereby you get through a renewal, you have quarterly updates. So actually, come the time you renew or you get closer to renewing, your existing carriers are clear on the journey through which you've been over that 12-month period. But I think against that, I think you ought to be sort of shopping around, engaging with other markets beyond those that you would ordinarily deal with. To articulate your risk, a market's appetite might have changed over the years. It may be that you've been out of touch with a certain market for a period of time. So I think certainly in the current market, you have to shop around. You have to understand what else is out there. Are certain markets changing in terms of their appetite? And might there be a market with whom you can engage going forward? So I think you do have to shop around. This current market would be my recommendation, my advice.
Stephanie, James, do you want to respond to that?
Yeah, I think that's right. I think there's a difference in between remarketing every year and chasing the cheapest premium for the last 10 years and chasing it down from there versus actually having a relationship with some key insurers and key markets. And I think where we're looking to now is to be able to pool and negotiate across all lines of business as well. So, our clients are really concerned with the total cost of risk and who's able to do that and who's able to support. Stephanie, I know that HDI very much supported that process, and some of the risks we've gone to and turned around and you wanted to write it all, but you couldn't quite write it all. But that's fine. That's a process to be able to go through. So I think relationship is key. Communication towards all those markets is key. But that doesn't mean that that's the same thing as chasing the cheapest price every single year that you possibly can.
From our perspective, we like a long-term partnership. Do I think it always pays? Probably not, but actually largely it does. We sometimes, if we've had a client for 3 to 5 years and the broker says to us we're going to remarket, that can actually work in our favour. And what we've seen over the last year or so, it works in our favour if a client does choose to remarket it, because it demonstrates what we are offering and the terms at which we're offering. So it isn't always what I would probably stress from an insurance perspective is don't just assume that we don't want things to go to market, because sometimes it does actually work for both parties, that it does, and it keeps us all straight and honest.
Thanks, Stephanie. We have a question that was sort of covered during our session earlier, but I wonder if we could tackle this also a bit more targeted way. Question that, do you agree that insurance claims efficiency has deteriorated during COVID-19, and how do we apply pressure to improve it? This is coming from insurance buyer. Anyone like to respond to that?
Claims efficiency.
Again, you come out in my end, I think. So go ahead.
I think our experience, it's going to be down to every individual, isn't it? So our experience has been that efficiency hasn't decreased much. I mean, I think the move to home working has been pretty effective. So, we've gone from doing, like I said, 250 video inspections to 2,500. All of that technology was, sorry, a month. So, but all of that technology was already in place. And what we've seen is a shift to using tech that was already there to use. So it's accelerated what was already happening. But it's been challenging, but I don't see a kind of overall massive decrease in efficiency at this point.
Thank you. We have about 2 minutes left to the end of the session, and I'll perhaps go around the room to give you half a minute to close and say some closing remarks before I share the link to the survey report for our audience today. So going backwards, if I may, Alex, and then working backwards, I've got to say some things in closing.
Yeah, I mean, I would say that having been involved in 3 of the surveys so far, and being on the panel at Airmic Fest, I think I'm really encouraged by what we're hearing from the panel about one of Airmic's favorite themes, which is working together, joining up the tripartite relationship, as I've heard it referred to before, to enable that better communication, which is the biggest single challenge in any industry or organization. But I think what we're seeing is that there's a real desire to work to overcome those barriers and to help fight the conditions in the hard market.
Mm-hmm. Scott, half a minute of
I'll do my best. Yeah, I agree with them. I think I agree with what Alex has said there. If I'm totally honest with you, I think I am seeing an improvement in areas on all sides. You know, that the market, brokers, from a client perspective as well. I think there has been that shift where we've all been pushed into having to sort of work in a new way. You know, I think with us all being sort of sat at home as we are now, there's been a need to make sure that we stay in communication. So I do see some improvement there. I mean, it would be interesting to continue with these surveys just to understand, how the landscape is looking in sort of 6 to 12 months, etc. So I think there is that improvement, and I support what Alex has just said.
Thank you, Scott. Richard?
Yeah, I think to echo the point about the surveys, I think they're really good because, unless you know where you are and what's wrong, you don't know where to start fixing things. Like I said earlier, we're always looking to improve things. So surveys like this, finding out from people what's important, where there are issues, enables us to focus on where we can expend our time and effort making things better.
Thank you. James?
I think the insurance and the people coming into the market, I think it's exciting. I think communication is key for us moving forward and being able to prioritise and address these. Technology is taking a far greater role to the greater benefit of everybody, which we're all there working hard to embrace rather than talking about. So I think it's not just conversation, but it's actually action that's going to count, and I feel that's going to happen over the next 12 to 18 months. Everybody's working incredibly hard.
Thank you. And Stephanie?
Yeah, so I think if you look at the surveys, and if you'd said at the 2019 or the 2018 survey, just to let you know, for 2020, you're all going to be going through a global pandemic and everything will be going to working from home. I don't think we could have anticipated the survey continuing in the same way. So actually, there hasn't been any market deteriorations. There has been some slight improvements. So I think there's every reason to feel positive about the future, even though, let's be frank, there's a huge amount of uncertainty in front of us all.
I think just to follow, I think that's so true. If you look at the 3 surveys in a row, I hadn't considered that, but the fact that the pandemic has forced us all to work in those different ways means that actually the response and the resiliency from the industry has been incredible.
Thank you. The survey report is now available as a handout to your column on GoToWebinar on this platform, so you can download it. You'll be the first to read it. It will also be later available on our websites, on the Airmic websites for download publicly. So do have a read and let us know your thoughts. And we will obviously continue this pulse survey perhaps quarterly over the course of this year. So with just 2 minutes over time, it remains for me to thank the panel today. Scott, Richard, Stephanie, James, and of course, Alex. Thank you very much for coming and sharing your thoughts and your responses to these issues raised in the survey. And we hope to have you again sometime. So thank you everyone for joining too. Goodbye.
Bye.
Thank you.
Thank you.
Cheers.